There are very few books in the history of finance that people return to not once, but over an entire lifetime. The Intelligent Investor is one of them. It is often introduced as Warren Buffett's favorite book, but that description barely scratches the surface. This book is not famous because it teaches people how to get rich quickly. It is famous because it teaches people how not to be destroyed slowly. And when you strip away the dense language, the old-fashioned examples, and the intimidating reputation, you begin to see why Buffett called it by far the best book on investing ever written. Most people approach The Intelligent Investor expecting stock tips. They expect formulas, ratios, clever tricks to outsmart the market. And most people put the book down disappointed or confused because Benjamin Graham offers none of that. What he offers instead is far more demanding. A complete reorientation of how you think about risk, behavior, and the role of emotion in financial decisions. This is not a book about beating the market. It is a book about surviving the market long enough for time to do the real work. At the heart of Graham's philosophy is a deceptively simple idea. Investing is not about forecasting, it is about discipline. The intelligent investor, as Graham defines it, is not someone with superior intelligence, but someone with superior temperament. This single idea quietly dismantles one of the most dangerous myths in finance, the belief that success belongs to the smartest person in the room. Graham saw decades ago what modern behavioral finance would later confirm. Markets are arenas of emotion, and most losses come not from lack of knowledge, but from lack of self-control. To understand why this book shaped Warren Buffett so deeply, you have to understand what it protects you from. It protects you from yourself, from your tendency to chase excitement, from your fear of missing out, from your urge to act when doing nothing would be wiser. Graham's writing constantly pulls the reader away from prediction and back toward process. He does not ask, what will happen next? He asks, what happens if you are wrong? That shift alone changes everything. One of the most misunderstood concepts in The Intelligent Investor is Graham's distinction between the investor and the speculator. This is not a moral judgment, it is a behavioral one. The investor focuses on safety of principal and satisfactory returns. The speculator focuses on price movement and excitement. Graham's warning is not that speculation is evil, but that most people speculate while believing they are investing. This self-deception is where financial damage begins. Buffett absorbed this lesson early and never forgot it. He learned that clarity about what game you are playing matters more than the game itself. Then there is Mr. Market, the most famous metaphor in the book, and perhaps its most enduring contribution. Graham personifies the market as a manic partner who shows up every day offering to buy or sell assets at wildly emotional prices. Sometimes Mr. Market is euphoric. Sometimes he is depressed. The intelligent investor, Graham insists, does not take guidance from Mr. Market's moods. He uses them. This metaphor is not about valuation, it is about emotional distance. Buffett has said repeatedly that this idea alone was worth the price of the book, because it taught him to see price as information, not instruction. Another pillar of the book is the concept of margin of safety. Graham did not believe in precision, he believed in protection. He understood that the future is uncertain, financial statements are imperfect, and human judgment is flawed. The margin of safety exists to absorb these errors. It is the space between what you pay and what something is conservatively worth. Buffett took this principle and turned it into a lifelong habit, not just in investing, but in decision-making. He learned to demand room for error before committing capital, time, or reputation. What surprises many readers is how conservative Graham truly was. He did not glorify risk-taking, he distrusted leverage, he warned against overconfidence, he encouraged diversification not to maximize returns, but to reduce regret. This conservatism shaped Buffett's early career profoundly. While Buffett later evolved beyond Graham's strict quantitative methods, he never abandoned Graham's psychological framework. He simply layered business quality on top of safety. The deeper you go into The Intelligent Investor, the more you realize that it is not really a book about stocks. It is a book about behavior under uncertainty. Graham repeatedly emphasizes that the greatest enemy of the investor is not the market, but the investor's own reactions to it. This idea, radical at the time, now feels obvious, but only because Graham articulated it so clearly and so early. Reading this book today can feel uncomfortable. It moves slowly. It refuses to entertain. It challenges the reader to accept lower excitement in exchange for higher survival. And that discomfort is precisely why it works. The Intelligent Investor does not seduce you, it disciplines you. It does not promise extraordinary gains, it promises protection against extraordinary mistakes. When Warren Buffett speaks about this book, he rarely mentions techniques. He speaks about mindset, about patience, about independence of thought, about having the courage to look wrong in the short term to be right in the long term. Graham gave him a framework sturdy enough to last decades, flexible enough to evolve, and humble enough to respect uncertainty. That is why Buffett did not outgrow this book. He grew into it. And as you begin to see The Intelligent Investor clearly not as a manual, but as a philosophy, you start to understand its real gift. It does not teach you how to win big, it teaches you how not to lose badly. And in investing, that difference compounds into everything. The book slowly reshapes how you view risk, price, emotion, and time, preparing you not for the next market cycle, but for a lifetime of decisions where patience matters more than brilliance, where restraint matters more than speed, and where the ability to sit still while others panic becomes the rarest and most valuable skill of all. And it is at this exact point when the book's true purpose comes into focus that the deeper lessons begin to emerge. Lessons that explain why Buffett's greatest edge was never superior analysis, but superior temperament, and how Graham's ideas quietly trained that temperament over decades, shaping not just an investor, but a philosophy of thinking that extends far beyond markets into life itself. And this is where the story truly deepens, inviting us to dismantle not just the book's concepts, but the transformation it creates in the reader. As we move into the next chapter, where theory becomes lived discipline, and discipline becomes a form of quiet power, unfolding further, like a slow burning fire that does not seek attention, yet endures long after brighter flames have burned out. And this is where The Intelligent Investor stops being a book you read and becomes a discipline you live. In the second half of Graham's philosophy, the focus shifts decisively away from markets and toward the investor's inner life. What Graham understood and what Warren Buffett absorbed so completely is that intelligence in investing is not measured by how fast you react, but by how rarely you feel compelled to react at all. The Intelligent Investor builds a structure so strong that most market noise becomes irrelevant, not ignored out of arrogance, but filtered out of wisdom. This is where Graham's conservatism reveals its deeper purpose. He was not pessimistic about markets. He was realistic about people. He knew that fear and greed arrive unannounced, that confidence often peaks at the worst possible time, and that losses hurt far more than gains feel good. So he designed an approach that assumed emotional failure was inevitable and then protected the investor from it. This is why he emphasized diversification, balance between stocks and bonds, and clear rules for action. These were not strategies to outperform others. They were safeguards against self-destruction. Buffett internalized this lesson early. He learned that the real edge in investing is not seeing something others don't, but refusing to act when others cannot stop themselves from acting. This restraint is visible throughout Buffett's career. Long periods of inactivity, cash, sitting idle, opportunities passed without regret. To outsiders, this looks like hesitation. To those who understand Graham, it looks like discipline at work. Buffett once said that investing is simple, but not easy, and The Intelligent Investor explains why. The difficulty lies not in understanding the rules, but in following them when emotions rebel. Another crucial layer of the book is Graham's insistence on independence of thought. The intelligent investor does not borrow conviction from crowds. He does not outsource judgment to headlines, analysts, or popular opinion. Graham was clear. If you let others dictate your emotional state, you will eventually let them dictate your financial outcomes. Buffett took this to heart. His greatest investments were often made when consensus was negative and conviction required standing alone. This independence was not contrarianism for its own sake. It was fidelity to a framework built on reason rather than popularity. As time passed, Buffett evolved beyond Graham's strict focus on cheap stocks, but he never abandoned Graham's psychological armor. He replaced cigar butt investing with high-quality businesses, but the margin of safety remained. Emotional detachment remained. Respect for uncertainty remained. What changed was not the foundation, but the expression, and that is perhaps the most powerful testament to the intelligent investor. It does not lock you into a method. It gives you principles strong enough to adapt without breaking. When you view the book this way, its true purpose becomes unmistakable. Graham was not trying to make you rich quickly, he was trying to make you durable. He wanted you to survive long enough for compounding to matter. He wanted you to avoid catastrophic mistakes, the kind that permanently remove you from the game. Buffett's success is often attributed to genius, but genius without survival is meaningless. Graham taught Buffett how to stay in the game, and this lesson extends far beyond investing. The mindset Graham advocates humility before uncertainty, skepticism of excitement, patience in decision-making, protection against downside applies to business, career, and life itself. The intelligent investor is, at heart, an intelligent decision-maker. Someone who understands that avoiding ruin is more important than chasing brilliance. Someone who knows that the future does not need to be predicted if the present is handled wisely. This is why the intelligent investor remains relevant in every market cycle. Technology changes, instruments change, speed increases, but human behavior does not. Fear still spikes, greed still blinds, confidence still overreaches, and Graham's framework continues to offer the same quiet protection it offered decades ago. It does not promise comfort, it demands discipline, but in exchange, it offers resilience. So when people ask why Warren Buffett still reveres this book, the answer is not nostalgia. It is gratitude. Gratitude for a philosophy that taught him how to think clearly when others could not, how to remain calm when others panicked, how to value patience over action, and how to build wealth not through brilliance, but through the repeated avoidance of foolishness. And that is the final dismantling of the intelligent investor. It is not a book about stocks. It is a book about character under pressure, about choosing reason when emotion is louder, about accepting modest returns in exchange for long-term survival. When you absorb its lessons fully, you stop looking for excitement in markets. You start looking for consistency. You stop trying to win every year. You start trying to never lose in a way that ends your journey. If this reflection changed how you see Graham's work or how you see Buffett himself, take a moment to sit with that shift. Share what stood out to you, because the most powerful investment lessons are not the ones that tell you what to buy, but the ones that quietly change how you think when it matters most. And if you want to continue exploring the philosophies behind the world's greatest investors, not as tactics, but as ways of thinking, stay connected. Subscribe, follow, and return. Because true investing wisdom does not shout. It waits patiently for those ready to listen.